This is Bite-Sized Business, the channel where we use financial metrics and ratios to gauge a company's financial health. In this episode, we will start a new series on American telecommunication companies. In this series, we will cover AT&T, Verizon, and T-Mobile. On today's menu, we have the second largest carrier in the United States with over 114 million wireless users, AT&T, or American Telephone and Telegraph. In the last 12 months, the company has done $122 billion in revenue, and the company was founded in 1875 by Alexander Graham Bell, the inventor of the telephone. Initially, AT&T was a subsidiary of the American Bell Telephone Company, but before the turn of the 20th century, AT&T would acquire the American Bell Telephone Company in a change of events. In 1974, the United States of America would file an antitrust suit towards AT&T. This caused one of the largest corporate breakups in history. In 1982, AT&T was split up into 7 different companies, and the parts of those companies now make up AT&T, Verizon, and CenturyLink, although CenturyLink divested most of its telecom assets to private equity firm Apollo Global Management and landline company Brightspeed. Most recently, AT&T has entered the fiber home internet market, servicing around 10 million clients as of September 2024. Let me introduce today's starters. Today's starters include the income statement, the balance sheet, and the cash flow statement. On today's income statement, we see revenue listed of $122 billion, EBITDA of $41.1 billion, and net income of $8.85 billion. If we take a look at the company's balance sheet, we will see in their most recent quarterly report they posted assets of $393.7 billion, liabilities of $275 billion. This includes $146.3 billion of debt, with a total equity of $118.26 billion. Taking a look at the cash flow statement, we can see the company posted operating cash flow of $38.25 billion, leaving us with a free cash flow of $20 billion. In the last 12 months, AT&T has spent $206 million on stock buybacks and $8.2 billion on dividends. Now off to the main course. Today's company was AT&T, who trades under the ticker symbol T. They're in the telecommunications industry. In the last 12 months posted revenue of $122 billion. This is relatively even from 2023 and up $4 billion since 2022. EBITDA came in at $41.1 billion, down from $45.3 billion, but up from $21 billion in 2022. Net income sat at just under $9 billion, down from 2023's $14.2, but up from the net loss of $7.5 in 2022. Total debt sits at $146 billion, with assets of $393.7 billion and liabilities of $275.3 billion. This leaves us with a shareholder equity of $118.26 billion. Free cash flow in the last 12 months was $20 billion. This was relatively even from the 2023 numbers, but up from the 2022 numbers of 12.4. Stock buybacks are very low for this company, with $206 million in the last 12 months, $194 million in 2023, and $900 million in 2022. Dividends for AT&T are much higher than buybacks, coming in at $8.2 billion, which is flat from 2023, but down from 2022's number of almost $10 billion. Taking a look at the ratios, we see AT&T posts a healthy debt-to-equity of 1.24, a slightly high EBITDA of 3.56, a strong EBITDA margin of 34%, and a healthy net profit margin of 7%. Buybacks as a percentage of free cash flow were 1%, as a percentage of net income they were 2%, the CAGR for revenue was 1%, the CAGR for EBITDA since 2022 was 40%, and the CAGR on free cash flow was 28%. Taking a look at the comparisons, we can see that AT&T posts a neutral debt to equity, a high debt to EBITDA, a high EBITDA margin, and a neutral net profit margin. Again, we have the capital distribution rank from the last series, and we're keeping the ranges the same. Due to the fact that AT&T has a high debt to equity and a neutral net profit margin, I can't justify giving them a green light, and so I'm going to give them a yellow light. This comes from, if we take a look back at the yearly stats, the high debt load the company has at $146 billion. While this is in a healthy range when it comes to their shareholder equity, and it is definitely sustainable on the $9 billion of net income the company has and the $20 billion of free cash flow the company has, I would prefer to see the company lower that debt a little quicker. I don't think they can do that at the cost of their dividend because they already don't do stock buybacks, and shareholders do like to see capital returned to them. But I think with $8.8 billion of net income, the company's debt will be sustainable for the future. The dessert section today is capital distributions back to shareholders. This section is always sweeter if you're a shareholder of the mentioned company. Total buybacks in the last 3 years were $1.3 billion. Yearly buybacks as a percentage of free cash flow came in at 1%. As a percentage of net income, they came in at 2%. Total dividends over the last 3 years were $26.2 billion. The company's yearly dividend as a percentage of free cash flow is 40%, and as a percentage of its net income is 93%. Total distribution over the last 3 years was $27.5 billion. The company's total distribution as a percentage of free cash flow on a yearly basis was 42%, and their total distribution in the last 12 months compared to net income in the last 12 months was 95%. Over the last 3 years, the company has paid out 26% of its EBITDA in distributions back to shareholders. This means that for every $100 the company does in EBITDA, a shareholder can expect to receive $26. Since we talked about AT&T's lackluster buybacks, I want to show off their shares outstanding graph. As you can see, in the end of 2009, the company had just under 6 billion shares. At the end of September 2024, the company had 7.2 billion shares. As you can see, they had a big jump in the middle where they jumped from a low of 5.2 billion shares upwards of 7.3 billion shares. This comes from acquisitions the company did. Approximately in 2015, AT&T acquired DirecTV for around $50 billion, and they bought Time Warner Cable in 2018 for $100 billion if you include the company's debt. This is why the shares have increased, but if you look in the last couple years, shares have decreased. This comes from divestments of some of the companies that they bought in the middle of the 2010s. AT&T is a company whose entire history is made of mergers and acquisitions, down from its split-ups into what were referred to as the baby bells, back into the AT&T we know now. AT&T's most recent acquisitions have come under some fire, and that's where they are part of the check today. AT&T has had some successful acquisitions like Cricket Wireless, but some unsuccessful ones like DirecTV. As mentioned in the shares outstanding section, AT&T purchased DirecTV for $50 billion. Most recently, AT&T is selling its 50% stake in the company to Apollo Global Management in a deal that values DirecTV at $16.25 billion. AT&T is expecting to receive $8.7 billion for their share. The other failed acquisition was Time Warner. Time Warner was a deal valued at around $108 billion, including the debt they took on from Time Warner. They most recently spun off their Time Warner assets in the form of Warner Media in a deal that lost AT&T $40 billion. AT&T spent roughly $108 billion to buy Time Warner, and from their spinoff they only received back around $65 billion. The reason that this is part of the check is that AT&T is one of the largest not only telecom companies in the world, but companies in the world. With this, they have a lot of cash flow, and with that cash flow they have tried to expand the business. AT&T's problem is they're unable to adequately expand the business in a way that sees successful long-term growth. Their most recent large acquisitions have cost the company almost $100 billion, and it shows the lack of skill in the management team to return capital back to shareholders in any other way than dividends. I hope you enjoyed this video on AT&T and urge you to join me in the next video on Verizon.